Investors Chronicle.
Companies and Markets Show. Welcome back, listener. It is Thursday, the 21st of July. As we record, just after 1 p.m. Delighted to welcome Alex Hamer back to the pod. Hi, Alex.
G'day.
Hermione Taylor, hello. First time on.
Hello, thank you for having me.
Lovely to have you here. Also, Julian Hofmann.
Yeah, great to be back. Thank you, John.
Welcome back. And Dan Jones hosting as ever. Dan, what is coming up on today's show?
First of all, we take a look at the miners, BHP and Rio, with a couple of second quarter updates in the past few days. And we'll be taking a look at a couple of the others as well. Anglo, maybe talking about Glencore next week. It's interims. Then we are going to be looking at our cover story this week, which is about economics and the passage of time in many ways, looking at different economic theories and whether, you know, this is a kind of back to the 1970s environment we're in or whether it's something else. And finally, we are going to be talking about Abcam, who is actually looking to move away from the UK and move to the US. And we're going to ask, you know, what should be done about that, if anything at all, and what investors can expect from those kind of trends. So yeah, quite a lot of interesting material coming up, hopefully.
Before we start, a little news roundup, and actually on the topic of listings, I just wanted to start with a company that we previewed last week. Halion became London's biggest listing for more than 10 years. I was going to say about it, but Julian didn't have his chance to talk about it last week. Julian, were you impressed with their opening?
Yeah, I mean, they fell quite substantially, I think, on the day. But it's a case of wait and see for them. I think that's investors are going to have to wait to see what strategy is, and Halion are going to have to convince people that without the pharma business that they're a sort of viable standalone in a kind of land of the giants, really, because it's probably the smaller of the consumer healthcare businesses out there. I mean, there are some really big companies that could snap them up without too much trouble. So it's really a case of whether they can defend their corner in toothpaste.
As you say, Julian, they debuted it at 330p a share, only to drop 7% almost instantly, down to around 308. Some other news from the continent this morning. Italian Prime Minister Mario Draghi has resigned, triggering alarm among investors and a jump in Italian bond yields as investors sell national debt. The sell-off has heightened the stakes for the European Central Bank, which has signalled it will raise interest rates for the first time in 11 years. In the UK, inflation for June hit fresh 40-year high at 9.4%, up from 9.1% in May. A few selected companies' lines, a growth warning from Deliveroo provided yet more evidence of a worsening consumer outlook. Management has slashed its growth expectations to between 4 to 12% for the full year, down from 15 to 25%. Shares in Direct Line took a 12% hit after the insurance company's trading update spooked investors. They warned that inflation in the sector was running well ahead of rises in premiums due to a combination of higher used car prices and higher than expected operating costs. Russian miner Petropavlovsk said on Monday it had asked its administrators to delist its shares in London and Moscow. Last week, the company confirmed it would not be able to make a loan repayment to Gazprom Bank. Alex Hamer, who's sitting next to me, has a full write-up on the company's recent history on the website. Is that?
Yeah, RIP PAG.
Elsewhere, the IC's Gemma Slingo writes that, quote, Royal Mail's trading update is a litany of woes. The company is losing £1 million a day with parcel and letter volumes down, and it has an adjusted operating loss of £92 million. And finally, Hotel Chocolat's shares tumbled by more than 40% on Tuesday morning on news that the premium chocolatier now expects to make a statutory loss for the year to 26th of June.
Thank you very much, John. So yeah, as mentioned, Alex Hamer, our news editor and commodities expert, is here to talk about some of the Q2 production updates. Obviously, the mining giants have been pretty big money spinners for UK investors as of a few months ago. There's been talk of a new super cycle. But more recently, that recession risk has started to emerge. And, there were a few signs of short-term headwinds, perhaps longer-term headwinds emerging in these updates. Is that fair to say?
Yeah, and I think to provide some context, usually these production updates there was a cyclone in the Pilbara and therefore we lost a few million tonnes of iron ore production for the quarter, which we will catch up on. these were a bit more eagerly anticipated because of the changed conditions since the last company updates. There was really a sense from management at Rio Tinto, BHP, that conditions have changed, and that's shown both in commodity prices and also cost increases. These companies are probably the biggest users of diesel in the world, if not, among the top users of diesel. And diesel is one of the commodities that's climbed the most this year, kind of ahead of petroleum, ahead of oil, ahead of lithium, for example. And so they've warned on those costs hitting earnings. So it was a reasonably rough set of numbers for production, and also in terms of earnings estimates to come for the first half off the back of these updates. But these companies have been riding high for a long time. Their share prices have taken significant knocks over the past few weeks as investors have looked at China, who's the main buyer of both copper and iron ore, which are Rio and BHP's main products, iron ore being the more important one. And they've looked at China and seen large inventories, which have narrowed since. So, there's a few different, facets to this, but basically share prices are down, earnings are likely to be down when the interims come out in the coming days and weeks, but it's basically priced in. And for even broader context, these iron ore divisions have been running at cash profit margins of 70+% for at least the past year. So there's a pretty solid base for these companies, even as commodity prices drop down.
So you mentioned China, and obviously, we focus, as I just did, on, the kind of recession risk, but that's obviously a huge factor as well, what China is doing. And there's probably two sides to that, one being the potential for stimulus maybe later in the year, the other perhaps some of the noises they're making on iron ore and their plans there. Yeah,
and on the stimulus, this is something that BHP CEO Mike Henry picked out as a positive factor for the rest of the year. How aggressively China chooses to stimulate construction, manufacturing sectors is yet to be seen. The growth number for Chinese GDP for the June quarter was 0.4%, which was the lowest since COVID hit, and well off the government's year-end goal of I think 5.5%. So it's hard to see into the minds of President Xi and his Politburo, but the decisions made there in terms of how much cash to throw into local government bonds, which fund a lot of construction and real estate activity in China, how much to support banks, all these kind of decisions flow through to the dividends of Rio and BHP, and to a lesser extent Anglo-American, which is a bit more diversified. So yeah, it's been a really interesting quarter for the big miners. And another thing that is interesting that might actually encourage a revision of longer term kind of iron ore estimates is China intervening in the iron ore market, in putting together a state-backed company that's become official this week, in the news for a few weeks now, but this company that will become a new middleman in the iron ore market in an effort to reduce some of the pricing power that Rio, BHP, Vale have, because China is buying 70% of the world's iron ore, and they do have pricing power, but I think they just want to change that relationship a little bit.
It's a bit piecemeal right now, and they want to buy it all at once.
Yeah,
effectively.
And there's a history in this, in that 10 years, slightly more ago, there was not much of an iron ore spot price market or spot market. It was all done through contracts, and Rio and BHP didn't like this. This was the kind of tit for tat that landed a man named Sterling, who in prison in China for bribery offences, where that was a reaction against Rio pushing for a spot market. So there's these kind of geopolitical moves that happened over a decade ago that resulted in the creation of the spot market, or the spot market growing in importance. And yeah, China wants a bit more of a say in the iron ore price. And I mean, at the moment, I can see why they want a bit more control when iron ore is at $160 a tonne US. Now it's below 100. It seems like the spot market's working a bit better for you now. So we'll see if they change their tact a little bit. But yeah, I'm interested to see where that goes.
Yeah. Well, back to the companies themselves, we have had a bit of a preference for BHP over Rio, which is still pretty much in place We talk a bit about why that might be.
Yeah, and it's that Rio has slightly more exposure to iron ore directly, and with the price move that we've seen in recent weeks, it shows that the kind of hit you'll get from the price dropping in terms of overall earnings, and that's a bit greater at Rio. Additionally, I see a bit more risk within their portfolio. So we've had major issues with Oyu Tolgoi, which is a copper project in Mongolia, where Rio has been building out an underground mine after they mined out an open pit resource. And so there's issues both with the ownership structure and the relationships with the Mongolian government, which is key for it going forward. BHP has for me and a lot of analysts I read, has a slightly better portfolio going forward in that they've got Jansen, this fertilizer project in Canada, which has seen a few billion sunk into it already, and it is kind of on the way to being a really important source of fertilizer. And I think the past 2 years has shown, or even the past 6 months, has shown how important that commodity is going to be for the world, as we've seen how, high gas prices have made fertilizer more expensive and hitting yields, and, let's see how much food we have next year. So, it's kind of, it's a pretty critical area. And like Anglo American buying Sirius out and taking on Woodsmith, BHP's investment in Jansen, or Jansen, however you like, looks pretty canny. But basically you've got two miners with group cash profit margins above 50%, which is it's a few percentage points ahead of where they were during the mining boom in the early 2010s. Quite healthy. So, I mean, Rio's got a few more red flags for me, but it's still in a fairly good position.
And the other shining light this year still, I mean, as you said, these companies have given up some of their gains in the past few weeks, but Glencore is still flourishing share price wise. It's got access to that coal market, which is delivering the goods. Production update, I think, next week, and then interims the week after. Thank you, Alex. Let's move on to our cover story this week, which is about looking forwards, not back to a certain extent, and looking at, I suppose, the way in which, we're all quite conscious of the economic situation right now, and it reminds us of, times like the 70s, maybe some different decades as well. But perhaps it's not quite as simple as that. Hermione Taylor, our economics writer, has written a piece. Economics, is quite a nebulous subject at the best of times, but it's fair to say that things are never standing still, and that maybe some of these comparisons could do with a bit more work, or perhaps, a simple shortcut, a simple shorthand, but not quite accurate in many respects.
Yeah, I think that's exactly right. I mean, the past certainly has a big pull at the moment, and I think the parallels with the 1970s are almost irresistible at the moment. So we've had strikes, we've got double-digit inflation forecasts, and we've got the stock markets looking pretty miserable. But even though these headlines look very persuasive, I think there are actually a lot more boring underlying differences. So firstly, the link between inflation and pay growth is weaker now than it was in the 70s. And this month's labour market figures showed that real regular pay is actually falling. So wages aren't even keeping up with inflation, let alone exceeding it. And this makes the risks of a 1970s style wage price spiral a lot lower. I think crucially as well, monetary policy in the UK is now set up to tackle inflation, and the Bank of England has said that it's poised to act forcefully if it needs to stamp it out. But then we've got worries about how high interest rates will go, and that's driving another comparison, and this time it's with the 80s. So the early 1980s saw the US economy tip into recession when the Fed chair, Volcker, wrestled with high inflation rates then. And he believed that the only way to bring inflation down was to convince the public that the Fed was getting tough on inflation. He got very tough indeed, and interest rates rose to almost 20%. So if the Bank of England is going to act forcefully, a high rate is going to tip us into recession now. I mean, it's not certain. We're used to inflation targeting now, and so in theory, the Bank of England should have to do less to persuade the public that they're taking it seriously. And the last time inflation was as high in the UK as it is today, interest rates were actually 13%, and they're not expected to go above 3.5% in this rate hike cycle. So there's a big difference there. In addition to this, we're also getting some kind of whispers that this is like the 1990s too. So we've got very low confidence in the economy, and we're seeing a lot of rumbling about, is the housing market going to slow down? In the 1990s, we saw a recession and house prices fell. So some homeowners actually entered negative equity. And we're getting an increasing number of headlines about whether history is going to repeat itself here. Again, the headlines look persuasive, but the reality is less convincing. Until we crashed out of the ERM, monetary policy was being used to maintain the value of the pound. So we saw some very, very high interest rates to defend the value of sterling. And as I said, I think the rate hikes are going to be more modest today. And it's also possible that low consumer and business confidence will be offset by our quite low unemployment rate today. So in the early 1990s, unemployment was almost twice as high as it is today. So I think none of these decades give us a perfect reflection of our situation today, but each of them does give us a glimpse of something that does feel quite familiar.
I suppose the 70s is, the obvious parallels with the high inflation period and things like that, but it's also the era people hark back to because, as you kind of say and you discuss in the piece, it was following that, with Volcker in the US and the rise of the will and the desire to stamp out inflation, that kind of new regime took hold. And from our perspective, it can be strange to think back then, to the extent to which inflation wasn't a big boogeyman in the closet until it actually really surfaced and spiked it in the 70s. I suppose thinking about this period, we've over the last decade at least, there's been a lot of concerns about inflation and easy monetary policy. There's been a lot of people worrying about what might happen if inflation does return. It finally has now returned. So some of those kind of, vestiges of the 70s and that kind of thinking are back. But it's a test, I suppose, of our framework and frameworks to see if they have changed and to see what we can do differently. But I suppose, we're always going to be comparing different eras, aren't we? It's a natural human instinct, I suppose, to look back and to try and, grasp for some kind of certainty and some kind of comparison that we can make sense of the present day with. There's
that phrase of history doesn't repeat itself, but it rhymes. So I think it is really tempting to look back. I think there is some good sense in this because I suppose if we look back, maybe we can decipher what's around the corner. We could work out where policy's heading. Will policymakers copy what was done in the past or try and avoid the same mistakes? I think that sometimes it can become unhelpful because sometimes we look back and we almost try and reassure ourselves that we've seen it all before and that, economics wasn't properly developed before, but now we've got all the tools that we need to tackle things ahead. I think that's actually particularly the case when we're looking back to the 1970s. There is some commentary from economists at the moment saying, oh yeah, the situation is similar, we've got high inflation, but at least we're not going to spend 10 years wondering what the solution is. We know what to do now, we know to put rates up. I think that's actually overly simplistic. I think it is a mistake to look back at the past as just a means of reassuring ourselves that today's economics knows what to do. I think there's actually a better argument that in difficult economic times, economics evolves to try and come up with new answers. So I think it would be wrong to assume that we've got the perfect finished version of economics that can handle all of our problems today.
Yeah, and this is something you talk about in the piece as well. I won't go into too much detail because if it does whet your appetite, that's something to pick up the magazine and have a look at. But we do discuss some of the ways in which economics as a framework could change in the months or the years ahead as well. I think there's been periods of time, as you say, economics does respond to the situations on the ground, or certainly policies do, and we'll see, as you say, whether the tools which we are using right now prove effective. There's certainly that comparison, of the sense, certainly in the UK, that we are once again behind the curve on inflation. But as you say, the Bank of England has now developed a pretty forceful way of looking at things. It's fair to say maybe things will change again if inflation proves more persistent, or even as we face up to some of the other economic challenges coming in the years ahead.
I had a question actually, Hermione, just before you move on. Sorry to interrupt. Why is it that nobody talks about balance payments anymore? Because that was a big topic in the 70s period of inflation. Has that sort of fallen out of fashion as a measure of what's going on?
Do you know what? I think it has. I mean, when we're looking at kind of headline indicators of what's going on in the economy, it's the kind of thing that you still learn about in an economics textbook as a useful indicator, but it has really fallen out the kind of commentary and briefings that you get sent. So I think it's a nice example of what we think of as important and what we think of as good economics. It does change all the time, and it has varied a lot over the years.
Yeah, because there was always that. If you look back in those files, you can always see there's this massive debate every month. Every time we imported an airline or something, there was this massive thing about all the balance of payments. But it's definitely not a problem anymore in the same sense.
It certainly doesn't get any airtime, really. Yeah.
Yeah, but it's also just to add to your history comment. The Karl Marx said that history repeats itself first as tragedy and then as farce. So we might be into the farce.
Yeah.
It's better than tragedy, but not much better than anything else, I suppose. I'm just going to throw another example in there, just to add to all the decade comparisons. That one I found quite interesting when I was looking for our Jubilee issue a couple of months or a few weeks ago at the 1950s ICs, and there were a few parallels there in terms of coming out of this big cataclysm, the Second World War in that case, obviously. The kind of shortages and supply chain issues you had then as well. But maybe that just shows it's easy to draw parallels with any era if you look at it very closely. So yeah, we shall see what happens in the months and years ahead, and do look out for that feature for a bit more detail on some of the kind of economic frameworks that might come to dominate our thinking, or certainly policymakers' thinking, over the next few years. Okay, back to the present day, the very present day. Today is a period or a day in which there's another UK company which is moving off the market. In this case, it's Abcam, and it's not been taken over in this case, but it is going to junk its dual listing and stick with only its Nasdaq listing, which I think it only introduced about 18 months ago. Now, for UK investors, this has a number of implications. Fortunately, most people on platforms should be able to, transfer those shares over pending the details of the situation, or the platform should be able to, rather, relatively pain-free. You've got obviously different tax implications, though, of holding US shares. And the bigger issue probably is, I think we can all say, is the oft discussed thing at the moment of the UK market to an extent dwindling away, or some of the big companies moving elsewhere. Obviously, we've got a huge amount of interesting companies still to buy, and we've got the likes of Haleon this week coming to market. But with the takeovers and with people prioritizing sometimes, the US listing, it does seem like things are starting to shift a little bit. And you can see why policymakers are doing the kind of things they've done this week with the publication of the Austin Review to look at how to make UK markets more attractive. Obviously, the FCA has changed its rules as well. So there's a lot of stuff going on in an attempt to bring the UK back up to speed almost. And Julian, I know you covered some of the aspects of the review and the new Chancellor's comments on it in the Mansion House speech. How do you sort of see the UK environment for companies at the moment, and in terms of the appetite there is for these dual listings and companies moving away? How's the balance kind of shifting?
Yeah, thanks, Dan. It seems to be a very specific movement. I don't think it's a general trend in terms of the entire market. Where we saw it most vividly is in the pharma and biotech sectors, i.e. sort of high-tech areas where companies have decided they can't get enough capital raising here in the UK, and have instead gone to the Nasdaq, where there's a bigger pool of investors. There are more specialized funds, for example. And as some of this is what the government is trying to address with its changes to listing rules. Yes, there's another review coming in that's supposed to report by the end of the year on how to make that process more efficient, which the Chancellor was talking about at the Mansion House speech this week. But it is a trend that's in a very specific area of the market. And I mean, by my calculation, there's about 15 companies since 2018 that had AIM listings of one sort or another, and then decided to move to the Nasdaq permanently, and they're all in that space. There's ones that people won't have ever heard of, like Achilles Pharma. There's even one called Bicycle Pharma. So I like to think of those as twins of some sort. But yeah, so it's a very specific movement. It's related to how companies perceive the ability to raise cash here at a certain level. Once it gets past the third round of private funding, there seems to be resistance for institutional investors, particularly, to taking up smaller high-tech companies into their portfolios, which is why they then tend to make a listing move to the Nasdaq. But it's been going on for quite a few years. So the first one I can remember was back in 2013 with GW Pharma, which made cannabinoid-derived pain medicines, and that caused quite a lot of discussion at the time about how they could reform the listing rules. And a mere 10 years later, the listing rules are being reformed. So yes, it did take a little bit of time, but it sort of kind of getting there in the end. I mean, the question really is whether it will make a great deal of difference, because it's really about the culture of how people want to invest rather than the ability of companies to offer a new product that everyone wants to buy into. So it's, are the institutional investors just too conservative to risk their shareholders' capital in a small biotech from Oxford? And it seems to be that in the US there is more appetite for those kind of small to mid-scale companies that could eventually turn into something much bigger.
As you say, it's an institutional investor issue in many ways. The US markets are much more liquid, and that's partly because people are prepared to back these kind of companies more forcefully. Perhaps, over the last decade, last 12 months notwithstanding, we've obviously, had a huge tech rally, and, there are, big UK tech funds now. Perhaps that's going to become, a little bit more, that will help the situation. We do have the, kind of golden triangle university spin-off kind of companies here who do very well. And it would be obviously great to see more of them persisting.
The universities are turning out the companies. I mean, there's a big hub up in Newcastle where they have quite a few innovative sort of medical and biotech companies. You go down to Exeter, now has a science park next to the university that's doing the same thing. So it's not really a question of talent or expertise. It's always that jump from being a promising idea to being a viable company, and that seems to be where we're always lacking in that sense. But I mean, the promising thing is that they still seem to be turning out the products and turning out the things that people want to buy. But it's the question of getting the institutions to buy into it, I think.
I mean, if it makes anyone feel better, the biggest one was Arrival, which was listed last year, the electric van and truck maker, and it's down 87% since it listed. So
it's not all roses over.
You can have them in New York.
Yeah, exactly. We will keep the quality. I mean, I think in some ways, it is true that biotech is one aspect, but tech in general, obviously you don't have the giants over here, but there are UK listed companies in that space doing good things, interesting things, fast growing things. So it's more a kind of a space for our readers to look into, slightly lower down the cap scale and find those companies that are slightly unheralded as well.
Yeah, I mean, this is Silicon Roundabout in Hoxton, isn't it? Was the tech area. I remember working there in the mid 2000s, and suddenly everybody turned up with really funny haircuts and tight jeans. And you kind of think, well, that's the area gone. We've got to move somewhere else.
Yeah, it's not for us anymore. But some of these people are producing fantastic companies still. The other thing I did just want to mention, I said we don't have the big companies anymore, but there is still some discussion over ARM and what's going to happen there when SoftBank lists it. The UK government has obviously been quite keen for it to come back to the UK market, having not cared too much when it was bought in 2016 and taken off the market. There was a very interesting story from our esteemed colleagues in the FT, I think last week, suggesting that obviously with the government turmoil here, there might not be anyone around, but the pressure on SoftBank to list them here. But of more interest perhaps to our listeners was the suggestion there that even if it were to list in the US, it could be potentially accessed via UK investors, that IPO via something like a primary bid offer. I think we've seen that before with, admittedly, a much smaller scale with the Soho House last year, which listed in the US but had a UK offer. So again, there are these mechanisms in place. And that's another thing the government's been trying to improve, I think, this week, in terms of making sure retail investors do get access to not just IPOs, but also secondary fundraisings, things like that. So there are, efforts being made to include the private investor in some of these deals a bit more than they were in the past, which is reassuring and can only be positive, I think. On that relatively positive note, that does bring us to the end of today's show. So thank you to Julian and to Hermione and to Alex and John. And thank you to you as ever for listening. We'll be back next week with another Companies and Markets show. Until then.